I'm not going to get too technical, or this is probably a bit more of a wordy presentation than a chart flipping exercise, to be honest. So I'm going to just go through where I think we're at right now. I mean, there's been a lot of consternation, or it seems that there has been in the last little while. It's not too surprising. I mean, a lot of the stocks that we follow in the space have seen some fairly decent pullbacks in the last month or two. Even the senior companies have seen pullbacks in the last month or two. People are getting a little bit concerned because they're not seeing the GDX and the GDXJ just marching higher and higher and higher. I'm not terribly concerned about either of those things. I mean, this is normal. You get corrections in a bull market. Indeed, if you don't get corrections, you tend to have pretty short bull markets. You need to have these periods of consolidation and cooling off. So far, we've had about a 10% drop from the high at the end of July, early August. My gut feel on this is as much gut feel as it is anything. I can't point to a specific hard reason for it, but I think we're probably pretty close to the bottom. We might have put a bottom in at the start of this week. It's a bit too early to tell. We really need to see the price lift 20 or 30 or 40 bucks from here before anybody's going to be comfortable about that. As far as equities in general go, hell if I know. It's an election month and an election year. It's pretty obvious that Wall Street's just enthralled with this idea of, is there going to be more stimulus? Is there not going to be more stimulus? Is it going to be monetary? Is it going to be fiscal? Is it going to be both? That's pretty much driving the bus right now. So I don't think there's any point in anybody giving themselves a headache trying to guess, because we're in the middle of probably a month of political brinkmanship here. It's going to flip back and forth probably several times a day. So honestly, I would probably try to ignore the noise as much as I could. And one thing that I want to move on to here is, okay, I'm pretty comfortable. Why am I comfortable? Why do I think we're probably going to start seeing things get a little bit better actually fairly soon? And in this case, I think it's going to be a top-down thing. My expectation is that we're going to start seeing a bit more strength actually at the upper end of the food chain, if you will, the GDX and the GDXJ. And I'm just going to go through this and sort of try to explain why. If you look at the chart on this page, this is year-over-year changes in median free cash flow for the 20 largest miners. And I'd like to thank Tavi Costa in advance for this chart, because I stole it from him. Thank you, Tavi. One thing that, there's been one of the reasons why people have gotten sort of a little bit spooked, I think, is because you did have these great numbers, Q2, which everybody was expecting. Everybody said, look, the numbers are going to be, they've got to be awesome with the move we had in the gold price. And in fact, they were. If you look at the right side of that chart, there's a pretty big year-over-year move. So people are asking themselves, well, why the hell isn't the GDX and GDXJ just blasting off? Well, partially it's obviously because the gold price has been consolidating. But to me, I think the important thing is, if you go back and look at the 2009-2011 period, which is where the GDX and GDXJ ultimately ended up much higher than they're trading right now. One thing to notice with that period is it's not so much that it was amazingly high quarter-over-quarter change compared to what we just saw. It's that it was a sustained change. I think that's what we need, because really to get these indices to those levels, it's going to be generalist money. And to bring in generalist money one quarter that looks amazing is not going to do it. They don't need to see 100% every quarter, but they do need to see growth every quarter. That's what I think locks in the generalist money. And there's no shortcut for that. We're simply going to have to see miners put up good numbers for 2 or 3 quarters in a row. And as that happens, I think we're going to see more and more generalist money come in. And just to reinforce that point, there's lots of Momo traders on the generalist side too. It's not just guys trading junior stocks. I mean, Jesus, I would say half the trading in Wall Street right now is momentum trading, maybe more than half actually. But I just want to give you, I took the chart for this year for the gold price from the start of the year, and I put in 2 rectangles. The first one being the second quarter period. That's the period where companies reporting, that's the average gold price they're dealing with in Q2. The red rectangle obviously is the gold price they're dealing with in Q3. you don't have to do a lot of math. You can just eyeball those two pictures, and it's pretty obvious. And the math will tell you this if you bother doing it. Q3 average gold price was a couple $100 higher than Q2. So odds are, unless they've really screwed up, and I don't see a lot of miners doing, they had none of them been sticking their neck out. They're still just trying to keep their noses clean, from what I can see. There should be another really good quarter dead ahead. We should see a whole bunch of very, very good reporting from the large and medium-sized gold miners starting in a couple of weeks. I think that's going to do a lot to help sentiment. It doesn't really do anything to guys that trade juniors all day long necessarily, but if it affects his sentiment and starts bringing the buying back in on the generalist side and starts pulling up the main indices in the sector, that'll go down the food chain, and that's going to help everybody. And that, like I said, that should start basically in a couple of weeks. You should start seeing that. So what happened here? What happened to the gold price? I mean, partially it just got ahead of itself. I mean, anybody that was watching, obviously late July or early August, things got ridiculous. It was very parabolic, which is very dangerous. When you get that kind of a move, you're always going to get some pullback. It's virtually guaranteed. You can't sustain that kind of a price move. But there's a couple of things that I watch all the time when it comes to the gold price and commodities in general, really. And this chart on this page is a big part of the story. I mean, if you look at the right side of this chart, you can see basically gold top right where the 10-year yield bottom. That's no coincidence. They tend to trade against each other. You saw a big move in August, and then it's had a couple more jags higher. It just had another one, and a lot of this is, it's due to a couple of different things. One is optimism in terms of how the economy, specifically the U.S. economy, is doing. The traders are getting more comfortable that everything's bouncing back. It's a V recovery, blah blah blah. They're likely going to be selling bonds, going into equities. That raises the yields. And although it doesn't look like much, if you look at a 5-year or 10-year chart of this, the last 2 months would look like a blip. But still, when you look at it starting at the beginning of August, it was a 50% move. 27 basis points only, yes, but still a 50-point move, 50% move. And when you think about it in those terms, gold hasn't really done that badly. It's had a 10% pullback. So the question is, what happens if this keeps moving higher? It will be a headwind, no two ways about it. If yields keep moving higher, that's going to be something gold's going to have to fight against to keep generating gains. But on the other hand, given how concerned the Fed continues to sound about the economy, the FOMC sounds far more concerned about the economy than the politicians in Washington do. I think odds are pretty high, whether they admit it or not. We'll see some sort of yield curve control, which is to say they'll be buying the long end to push those rates down, bring down the 10-year yield, the 20-year yield, flatten the curve. I think you'll see them do that again if it moves that much further, whether they admit to doing it or not. I think that's what will happen. The other reason, of course, and again, in the scheme of things, it's not much of a bounce, but still, there's been a bounce in the US dollar. And again, that's a combination of economic optimism and just the move in yields, because one of the biggest determinants in terms of where a given currency trades is what the real yields are in that economy compared to all the other currency blocks. The US has seen they're still negative, but they've gone up because of the rise in 10-year yields. And also actually because the inflation expectations have fallen off a bit. I don't touch on that much in this talk, but I have to be honest. I'm not completely sold on the inflation is going to take off theory. I understand the argument behind it, and the argument gets stronger and stronger the more fiscal spending there is. Not so much monetary stimulus, but fiscal. Fiscal is the one that's most likely to generate inflation down the road. But we've got to get through all this COVID crap. I just don't see how we get anything in terms of an inflation spike in the short term. I think we're a lot more likely to get a deflation spike, frankly. I still think that's not off the table, although the Fed's trying pretty hard to make sure it doesn't happen. But nonetheless, the other reason for gold sort of tapering out, and it didn't help other commodities either, was this little bump And so far, it is still a little bump. There's a lot more gold. There's a lot more US dollar bulls around than there were a couple of months ago. I'm not totally sold on that. A lot of the real dollar bull argument. I mean, you know, people think it's going to go to 120, 130, 140 on this index. That only happens if there's an extreme shortage of dollars, and I'm simply not sold on that theory either. I've seen it laid out 100 different ways, but I'm looking at the market, and what the market's telling me is that there is not a dollar shortage. I could see different sets of circumstances where it would happen, but I don't think it's happening right now. And I think odds are, with the FOMC still in play, with more fiscal stimulus probably in play, I think the most likely balance of probabilities is the US dollar drops lower again. I don't think it's going to fall off the cliff, but I think it probably goes. I think it probably gets lower again. Should the Fed be as worried as they are? There's a lot of people are pretty cynical about the idea of more stimulus. They don't think the stimulus so far worked. I personally, I think it probably did. I think if the Fed hadn't done what they did, I really think things would have blown up like really, really, really badly and stayed blown up. So I'm not in that camp of the Fed that was wrong. I think they did what they had to do this time. I think Washington and Ottawa and London and Paris and Munich, they all did what they had to do this time. They had to throw money at this problem because if things cascaded so quickly. The concern, when I look at what's going on right now, I understand why the Fed's, sounding nervous. And just in the last couple of days, Powell's done a couple of talks about like we need more fiscal stimulus. And I think these two charts give you a pretty good pretty good idea what he's concerned about here. If you look at the chart on the right, this is just the monthly non-farm payrolls that we see every month. It's always a big story. You can see how, obviously it was horrendous. In March, we got a couple of big bounces, like huge bounces, which we should have coming off of something like that. But you can see the trend of these things has been going the wrong way. And the September number, 661,000, sounds like super impressive, and it is in a normal year that would be. But we're coming off of this huge loss, and it's going to take a lot of months like that to get rid of the rest of the deficit if we ever do, that was created early in this year when it comes to employment. And when you look at unemployment claims, like the number that came out this morning, again, people are going, oh, great, it's down to 840. That's a real improvement. That's the highest unemployment claims in the U.S. If you ignore the last 6 months, that's the highest it's been since basically right at the end of the great financial crisis. So it's not that good a number. It just looks good compared to what 3 months ago looked like. And the bigger concern, I think, for the Fed and for a lot of people and for me, is this chart here. And what this is what's classified as permanent job losses. There's a couple of different ways this is done. I think this particular chart, this is probably more than 6 months. There are also people that are just basically counting this from large organizations doing layoffs when they're saying these are permanent, these aren't furloughs, these are permanent ones. And you can see how much this has climbed. It doesn't look right now all that scary, relatively speaking, compared to the GFC 12 years ago. But keep in mind, we're only really a couple of months into this, and assuming there's no stimulus in the next little while, you're going to probably see climbs like this month over month over month for the next 3 or 4 months, and it's going to hit that number that we saw in the great financial crisis pretty quick. It could theoretically get there by the end of the year if we don't see more fiscal stimulus, because there's a wall of these layoffs dead ahead of us right now. Do I think they need another jolt? Yeah, probably. It really depends on, if you're going to be very, libertarian about it, then yes, of course they don't. I find it a little difficult personally to think of that many people being in so much trouble in the economy. So I'm afraid I'd be one of those lily livered types that would probably be voting for more fiscal stimulus. And I do think it's needed, because once we get through the next month, if there isn't anything at all, the way the politics are working right now because of the election, I'm assuming if we don't get some kind of smallish targeted fiscal in the next couple of weeks or 3 weeks, we probably don't get it until January. because I assume whoever wins the election, keep in mind the U.S. election, the president stays there until January. So, if Trump wins, he might try to pass a really big one, but I'm not sure his Senate would go along with it if he had the Senate majority. Biden wins, he's definitely going to want to do one right away, but he's not, he's not the president. Trump, and for that matter, the Senate are in a position to pretty much block anything until things hand over officially in January. So I'm thinking if we don't get stimulus next couple of weeks, we don't see it for 3 months, that could get a little bit ugly in the middle, which isn't necessarily going to be bad for gold. And as part of that thinking, I just threw up this chart, which is kind of an interesting. This is kind of an interesting chart. I'm not sure I'd take it as literally as this. I mean, because I'm not sure exactly how they work this number out. I'm a little dubious, even given this year being this year. I'm a bit dubious about this drop. But bottom line is, there is a correlation, not surprisingly, between the U.S. dollar and this is a different U.S. dollar measure. This is a broad weighted U.S. dollar, not the same as the index I had a couple of slides ago. But there is a fairly strong correlation between that and political uncertainty, and I don't think things get a hell of a lot more uncertain than they are right now. So I understand that if you read this chart literally, this is just another reason why the U.S. dollar is probably going to have a rough 2 or 3 months ahead of it, which is obviously good for gold, and it's good for base metals, it's good for commodities in general if that happens. And just to keep everybody on an even keel, I thought it'd be interesting just to put this chart up. It's interesting to note that even with gold kind of pulling back 8 or 10% over the last 3 months, we're not seeing a big decrease in ETF holdings. I was actually surprised with this chart myself. This is a very recent chart. It was like yesterday. I was actually surprised by this. I expected actually to see a dip in the holdings, but that tells me there's a fair amount of, I think, big money still accumulating this stuff. I mean, they're not going to do anybody any favors. If people want to sell them gold at $1,800, they'll buy it at $1,800. They're not going to bid it through the roof. But I think the basic demand at a large scale for gold holdings, both physical and ETF, continues. And I'm going to reiterate again. I've said this for the last 3 or 4 times I've done these talks, and it hasn't changed. The basic backdrop that's driving this whole thing in gold, and to a lesser extent even driving in base metals, has not changed in the last 9 months. It's probably not going to change in the next 5 years. This is not a situation anyone's ever seen before. There's no easy way out of it. I don't see how the G7 central banks keep things on an even keel without continuing to run negative real rates. How negative they are is going to vary. Like I said, I'm not personally that sold yet on the whole inflation spike idea. Yeah, there might be one at some point, but I don't think it's going to be short term. So we got to expect these oscillations. Gold's probably going to keep continuing to trade in a large range, but that's good enough to do what we needed to do, which is to give us enough backdrop so that the stocks we're interested in can still do okay. I don't love the idea of more stimulus, but I think we're definitely going to get more in January. I just don't know about this month. I think there's going to be some. I suspect there will be some targeted programs. It's too much in the interest of both sides of the election for it not to happen. I think the Fed may start flattening the curve again especially if they don't see some action on the part of Washington. I wouldn't be surprised to see the Fed go back into the market, because I think the FOMC really is quite worried that things are going to stall out if there isn't one more jolt. And keep in mind that a lot of the pullback that we've seen in exploration stocks in the last couple of months, it's not even the gold price, it's not even the broad equity markets. It's the simple fact that after years and years of pain, going into April, May, June this year, companies are finally able to raise money. There was a lot of money raised in May and June. A lot of it was done at lower prices than now, which is great for everybody. But the downside of that is you've got a lot of people in a position to take profits, and a bunch of them are. And I don't begrudge anybody. I think it's a good idea. If you bought a 10-cent placement, it's a 50-cent stock, you're crazy enough to at least get your money back out. So, and even if people like those stories, they're going to do some profit taking. There's no there's no simple solution. Nothing really fixes that other than time and volume. I'm not that worried about it. It's just something that we have to go through. Again, standard thing in a bull market. You'll get these periods of profit taking. We're in one now, but it's not the end of the world. So part of that probably says, don't get freaked out by this. I think we'll be fine. We got a lot of gold bull market ahead of us. You probably don't need to be as aggressive right now because there's obviously people putting stock in the market, but that's a case by case thing. Some companies have done a lot of cheap placements, some companies have not. Some of the newer stories that didn't really do a lot of cheap raising, a lot of those stocks have actually held up quite well. And more to the point, we're still seeing companies that have delivered, news about new and exciting looking discoveries. They are still getting love from the market. Not every day, not all the time, but by and large, those stocks are still going from the lower left to the upper right, and that's what we want. And I've got two good examples that are going to follow me here. One of them, interestingly, they're both base metals, and they're both trading very well this year, essentially on discovery news. And the third company, I'm expecting them to be discovery news of the near future. Hopefully, that's how it'll go.